Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Wednesday, October 23rd, 2024. Today's episode, we're going to start bringing up the very popular narrative going around involving how long rates, bond rates, including the 2-year all the way throughout the 30-year treasury yield rates are going up, and stocks dropped today, supposedly because of that more than anything else. I'm not sure I agree with that exactly. While we're sitting in sort of maximum treasury fear mode, I personally believe that it is highly probable, if not likely, that this is the last best chance to get into longer dated treasuries. And I'll go through some charts and explain what I'm talking about. One thing that I think can help keep our heads screwed on straight is my response to this is that simply that higher yields fight inflation. And so we're going to start by looking at the 2-year treasury yield and 10-year break-evens. From CNBC.com, we have the 2-year treasury yield. This is a 1-year time horizon chart. As you can see, this has been going up and up and up. And so what many people are correctly saying is that, okay, so the market is currently believing that, rates won't be dropping as much for the next 2 years on the front end of the curve as we had previously thought. And I agree. It has to do with the fact that we haven't seen another major break in unemployment going up or initial jobless claims spiking. Not yet. I mean, this is all while the leading indicator index is just still tanking, by the way. So I think yields on the upside are getting overly optimistic here. The very ironic part about yields going up is that while yields go up and their respective treasuries, the prices drop because the current treasuries that already exist, they already locked in their yields, right? And so if there's a higher yield available, then it makes the current bonds that already exist drop in price. Now, the very ironic thing is that the higher the yields go, obviously, the more attractive they become for buying. And so, the market, it basically fixes itself. The important question here, though, is, are we pricing in higher inflation or not? It might be surprising to some people, but the answer is no. When we take a look at the 10-year break-even inflation rate, the difference between Treasury inflation-protected securities, otherwise known as TIPS, and the regular Treasury bond, the regular 10-year, it's called a note, actually. You don't call it a bond until it's a 20-year. The 10-year note, we can see that since October 10th, we've actually gone down a little bit. We've gone sideways, we dipped down, and we're going flat right now in the 10-year break-even inflation rate. So while yields are rising, we're not seeing the market say that they believe inflation is going higher right now, at least right now. Of course, the 10-year break-even inflation rate can go up from here. It's something to keep a close eye on. As it stands currently, it's flat to down, if anything, the inflation rate. Granted, from September 10th, we did have that spike, but we're going flat to down now. And it could go anywhere from here, really, honestly. It could go up, it could go down, it could go sideways. And we don't know. We don't tell the chart what to do. We just keep a close eye on it and see what it tells us. Again, The problem to inflation and higher yields is higher yields themselves, because they make themselves more attractive by being higher. And so we really need, if we want to get a sense as to where inflation is going, the only best place to look is the 10-year break-even inflation rate. All other markets, including gold, Bitcoin, silver, treasury yields, stocks, commodities, oil, all of these things are involved with the way inflation works. But when you want to know where inflation is expected, this is the only chart you should be looking at, the 10-year break-even inflation rate. If this starts to go out of control to the upside, that's when to get worried about inflation. Right now, no. As it stands, it's 2.3%. A last piece to this puzzle has to do with the dollar. While oil has stopped collapsing, while all these other markets are doing what they're doing, the dollar is continuing to rip higher. There currently is not fear of the dollar. There is a run to the dollar right now. While everyone else out there is saying things that are contradictory to what I'm saying, these charts don't lie. Tomorrow, on Thursday, look out for PMIs and initial jobless claims, one or both of which could have a strong effect on markets. If you want to hear me read through the daily reminders, watch Monday's show. Nothing has changed as of today, and the crystal ball reading remains bear market very soon. I might change this to imminent. I'm halfway between very soon and imminent at this point. My spidey senses and my crystal ball see a black swan event coming, to be honest. But either way, I believe there's a bear market coming very soon, and the Fed won't cut fast enough to save the economy. I believe we're headed into a recession or a depression in a hard landing scenario. SPX, the S&P 500, had a pretty good drop today, almost 1%. We actually dipped down for a lot further than that. Pretty big tail here. I don't know if this is going to get bought and go higher or keep going down. I think this index as a whole is massively overpriced, especially considering how high treasury yields are. They've been going up, and now all of a sudden everyone is waking up to the fact that treasury yields are higher than what they should be compared to the valuation of the S&P 500. I've been saying this for a long time, but finally the S&P 500 is, Mr. Market just rubbing his eyes and what's going on? That's kind of how I feel about it. The 10-year treasury yield still rising. As I've been saying, it looks like it's headed straight to this line. I mean, why wouldn't it be? Again, this line represents a very, very long term, a major trend line. The top of yields being in April, March of 2021, and then forming a head and shoulders top on the 10-year treasury yield right here with a pretty clear neckline and everything. Then we cracked it, and now we're retesting it. So it'd be highly normal for as far as a chart pattern goes to go up to this, getting to the 4.38 range. I will be loading into treasuries at that point. I mentioned earlier on the show how oil had stopped dropping. It's not going down or up right now. We're going sideways basically. So oil, maybe this is forming a head and shoulders top to head lower. Not really sure. The total amount of rate cuts coming up has been reduced. It was only about less than a month ago when we had strong probability of dropping to a target of 3 to 325 or 325 to 350. for the summer of 2025. And now we're saying that the terminal level is only going to be at 375, and the market's not expecting more cuts after that at the moment. Again, Fed fund futures change on a daily basis, and say we get some black swan event, this will start flipping the other way. I mean, it's more dependable the closer the cuts go, and so I've learned to really try to not look too far out on the Fed funds futures, although it's using what we know today to predict as best we can where the cuts are going to be, going out about a year. So as they say, don't fight the Fed. I don't tend to like to fight Fed funds futures, except for the fact that, Fed funds futures were wrong for a very long time regarding like when we were going to have the first cut. They kept pushing it out, pushing it out. And that has to do with the large amount of fiscal debt that we have in the U.S. And I'm still in the camp that the other side of that coin, of the same coin, is when we're cutting, it's going to have less of a stimulatory effect, and therefore there will be more cuts coming sooner. I think the Fed is going to cut much more aggressively than what the Fed fund futures currently says. But I could be wrong about this. If you just glanced at this chart, you'd say, oh, that's the S&P 500. Exactly the same candle as the S&P 500 today. Amazing. Bitcoin, it's like a mirror image. I'm currently in the camp that I have no idea if Bitcoin's going to go up or down, and I don't care at the moment. But if we close above the 75,000 mark, I'm pretty sure we're going to head straight up to 100,000. And if the price drops very significantly, it could be an interesting thing to buy. Either way, I don't like where it is right now. It's kind of interesting. It's like if it goes up, I'll buy it. If it goes down, I'll buy it. But right now, I'll just sit on my hands, I guess. I'm still short SMH, holding SOXS. This looks like an unbelievably great setup as far as a chart pattern goes. We have the white whale double engulfing candle at the top of the market here. We have a head and shoulders looking top. Every time we get one of these big engulfing candles in recent history, it's led to a pretty severe downturn. We just had this large one. We are setting ourselves up for a big collapse. This is while the S&P 500 is dropping, which helps the bear case of this. The yields on the 10-year note are rising. This is just forming the perfect setup for this to continue dropping lower. If we break this neckline here, good chance that SMH will, in my opinion, easily lose from the top 50% of its value. Further supporting this is the fact that there's an enormous amount of speculative price priced into these companies, as if they're just going to make infinite amount of money. Trees grow tall, but they don't grow forever. Other charts that caught my eye today, silver. We had yesterday, again, this newer green candle is because it's on UTC time. Yesterday's candle, very large green candle, and today's candle engulfed it to the downside, including this last one. So this actually looks like we may have already peaked in silver. We may roll over here, interestingly. K-Web, interestingly, holding up right now, not looking bearish. We had broken out to the upside on this declining wedge after a massive, unbelievable rally in this market, and it's going sideways. It's not bullish or bearish at all right now. If anything, because we came out of this wedge in this big move, if anything, I would expect it to go higher, but I'm not sure. A fair price for this, when it comes to valuation, for me is around the $45 to $50 range, and so that's where I'm waiting to sell out. or at least do some kind of trailing stop loss. I almost put this on like the past like 4 or 5 shows, but I restrained myself because it just wasn't looking like it was doing anything. MSOS, this is cannabis ETF. I had been noticing that we've been coiling up very, very tightly for quite a long time in a market that's normally quite volatile. We can see huge moves to the upside and to the downside. So the fact that we've been coiling up for a long time had me interested. Okay, is this preparing to break down or to the upside? We broke to the upside actually yesterday, and with a little bit of follow through today. So it's a market I like to keep my eye on. I'm not sure what's driving this. While all the risk assets are selling off, it must have something to do with what's going on in the industry involving regulation or something. Just the market I like to keep my eye on. From the beginning of this fund, it lost something like 95% of its value, and I made good money buying it literally at the bottom, like almost to the penny, and riding it for a few waves higher. So, yeah, just keeping my eye on it. As dumb as this industry seems to me to be investing in, to lose 95% of an entire index is a little extreme. So that's why it's fun to pick up the cigarette butts, if you will. There's got to be some value here. Sorry for tripping over my words a little bit today. I'll try to do better tomorrow. I think I had too much coffee or something. Anyway, that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.